So, what's the most shorted investment out there? Is it Bitcoin, Dogecoin? Is it stocks? Is it Forex? What do you think? It's bonds. It's actually bonds, the most shorted investment out there, and that is that people are still bearish on. And we're not talking about a little bit bearish, we're talking about massive bearish positions from very key people out there, key group of people, which I'll talk about shortly, are shorting bonds. If you've been looking and following bonds or the bond market at all since the start of last year, bonds have been just selling off, selling off, selling off as interest rates were going up and these yields were going up. Mainly because the Fed went on a super hawkish tightening mode since a very long time. They started raising rates, they started doing quantitative tightening, which caused bonds to really sell off. But I thought bonds were safe. I mean, they're safe depending on which bond you buy. If we're talking about, and I am talking about the U.S. Treasury market, U.S. bonds, the government bonds out there, right? Those, yeah, definitely, they're very safe. Although, yes, you did get a downgrade from one of the rating agencies out there on the US, but still, compared to many of the countries out there, US is known to be one of the safest places to park your money. And especially when you're talking about US government bonds. But why are they so heavily shorted? And is this a bad sign? Could it mean something else? What does this mean for the economy, the yield curve, and so on? What could come out of this situation? Well, I'll talk about it today. And before I get into that, my name is Daniel. I run an organization called InfraVest. InfraVest is an organization that promotes financial literacy, teaches you about stocks, bonds, commodities, currencies, and yes, even cryptocurrencies. We've got courses on this. If you like macroeconomics, we tie macro with the investment world, and it's all in our courses. If you're interested, search www.infravesting.com to learn more. Now, the most shorted investment out there, yes, it's bonds. Bonds, we're talking about the 2-year bond, the 5-year, the 10-year, the 30-year, all throughout the curve, the duration. They're all been people have been shorting them, investors have been shorting them since the start of last year. Now, when you look at certain bonds, like for example, let's take the 2-year. The 2-year has been heavily been shorted because you see the yield curve is inverted, and the reason it's inverted is because the 2-year yields have been moving up more higher than the 30-year. So the yield curve, generally how it should look like, it should be upward sloping. So meaning that the 2-year, in a healthy normal environment, the 2-year bond should have a yield lower than the 30-year. So the 30-year yield is higher than the 2-year. But when things start to get a little bit worse off, and especially when the Fed starts to tighten aggressively, this yield curve, which is upward sloping, tends to change. And then the yields, if we're in a rate hike environment on the short end, tend to move up more than the 30-year, which causes the yield curve to basically flatten and then eventually invert to a point where the 2-year is offering you a higher yield than the 30-year. And when this happens, it tends to tell you that, hey, there is a recession around the corner. So that's why people look at the yield curve, and every time it inverts, you get articles talking about, the recession's around the corner, or you may even get articles, which many times it happens, that this time is different, and that this yield curve that's inverted doesn't signal a recession, and blah, blah, blah. But that's not the point here. What I want to get into, what I want to talk about, is that who's shorting these bonds? And why is it so massively shorted? Well, when you look at the Commitment of Traders report, you do see that large speculators are massively short bonds from the 2-year, the 5-year, 10-year, and yes, even the 30-year. So large speculators are massively short bonds. The commercials out there who are in the business of hedging, they're long bonds, but small speculators, retail traders, surprisingly, if you look at the 30-year bond, they're kind of long. They're slightly long there. So you've got large institutions, large speculators there who are shorting the 30-year bond, and you've got small retail, small speculators out there who are buying bonds. So who is right here? I mean, bonds have been selling off aggressively since the start of last year. How much more lower can it go? We did hear from Carl Icahn saying that, hey, the 30-year yield might go to 5.5%, meaning that the 30-year bond is going to sell off further. And we did see in March of this year where there was a problem with the regional banks in the US, where many of them were going bust. There was panic in the markets. And off that panic, since it was a risk-off environment, you had bond prices basically jump up really fast and the yields drop. And you had this steepening happening, and then on top of that, with all this fear, bonds were being bought, and institutions, these large speculators who were short and also still short, many of those hedge funds got squeezed or even margin called, which caused also this massive rally in March, right, during the regional bank issue. But when you look at the prices from March till now, we're back to lows again, and bonds continue to sell off and sell off and sell off, and the 30-year is now starting to sell off more than the 2-year. And I talked about this in my previous bond video. Just check it out. It was last week. And the 30-year is selling off more than the 2-year, which is causing currently a steepening in the yield curve. And the reason that's happening is because the markets are basically testing this soft landing narrative. They're basically saying that, hey, inflation may be sticking around for some time. Fed hasn't really indicated much in terms of more rate hikes. And if that's the case, if inflation might be sticky for some time and not much rate hikes, then you might get actually, a soft landing scenario there. But if the long end yields continue to move up and up and up, and we start to steepen, to what point will this create panic or break the markets, right? Especially with a lot of large speculators who are still short. And will we see that, right? We did see yields on the 30-year pop up and then come back down. Could Carl Icahn be right that we could see yields go to 5.5% or higher? Well, if the economy and the growth and inflation picks up, then sure, you might see that. And that may cause the little speculators, the smaller speculators, to then sell and panic sell, and that might also add on to the selling in the bond market until you get that same March event, a risk-off event. And that might be that yields maybe go to 5.5% or higher, something breaks, and then all of a sudden, you've got small speculators, large speculators who are short, which then adds up to the biggest rally and biggest squeeze that you might see. And then everyone piling back into buying bonds. So the 30-year bond especially could be posed for a very big rally. It still may be a little early, but it can happen just like in March when we saw that big pop, that big spike in prices. We could see that again if there is a big credit event something that affects the economy? Let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.